Buongiorno, buon pomeriggio a tutti. Io sono Michele Cervone, intanto auguro un benvenuto a tutti i presenti. Oggi più che mai propizio parleremo di bond. Vista la situazione anche di questi giorni è stata propizia la nostra idea di parlarvi di bond. In questo caso avremo come ospite, chiamerò fra poco dopo un breve filmato, un mio collega Miles Bradshaw, che è gestore e a capo di tutta la parte aggregate globale, quindi bond di alta qualità di JP Morgan, che farà un suo intervento, dopodiché ci saranno delle domande, un'intervista susseguente al suo intervento. Prego la regia di mandare il filmato intanto.
We stand up for democracy. 1 year later, we know the answers.
What a difference 1 year of unity and resolve can make.
A new era of globalization.
Easing of its zero COVID policy.
What if the good news of China growing faster translates into oil and gas prices jumping up?
Further sanctions.
A sharp drop in energy prices.
The Inflation Reduction Act would be the most significant legislation in history.
A level playing field in the global competition.
A subsidy war about very good things is basically a good thing.
Climate action is impossible without adequate finance.
The bear market rally.
We have a significant road ahead to get inflation down to 2%.
A rate-driven rally.
Don't fight the tape. Don't fight the Fed.
Hard landing or soft landing?
No landing scenario.
Is the risk of a hard landing?
Soft landing is possible.
Soft landing.
We intend to raise interest rates by another 50 basis points.
The ECB could tighten too much.
Risk of over-tightening.
Healthier footing than expected.
Machine learning algorithm.
AI is going to completely change what people can expect from search.
Opportunities to change.
To become first movers.
Do the right thing.
Di nuovo benvenuti, le domande sono tante, ad alcune di queste cercheremo di rispondervi oggi pomeriggio. Chiamo sul palco Miles Bradshaw, Global Head of Aggregate Strategies di JP Morgan. Grazie.
Grazie Michele and buongiorno. I have to apologize first. I have been working on my Italian, but it is still not good enough to do a presentation about bond markets. So if you bear with me, I will switch to English. I prepared this presentation to make the investment case for bonds in 2023 last week. And since then, we've had the news about Silicon Valley Bank going bust. So what I'm going to do is to go through the presentation and bring in how I think the changes that we've seen on Friday with the bankruptcy of Silicon Valley Bank affect the outlook for the bond market. But the simple message is, it amplifies the message of the presentation. First, last year was a bad year for all financial assets. We were surprised by higher inflation, higher interest rates, and most importantly, falling bond and equity prices. The silver lining is that higher bond yields create better valuations for fixed income. This chart here is the real yield, so that's the yield on inflation-linked bonds globally. You see it got to about 1%, which is in line with its 25-year average. If you look at 10-year US Treasury yields, real yields, that's the nominal yield, less inflation expectations, they reached 1.5%, which coincidentally is the 100-year average return after inflation that has been realized in government bonds. Valuations are the key driver of any investment thesis, but on their own, they're not quite enough. To gain conviction, you have to have catalysts that give you confidence that prices are going to correct. The first one that's most important is inflation. We think inflation is on its way down. The journey is going to be bumpy. The chart on the left shows in yellow is the PCE, the headline measure the Fed are targeting towards 2%, with the bold line showing PCE inflation versus 12 months ago. And the dotted line, a more short-term measure of inflation, which is PCE inflation over the last 3 months versus the previous 3 months at an annualized rate. And in blue, you have the same data for core PCE, so that's PCE excluding food and energy. What you clearly see is that inflation is slowing. The question is how quickly it's slowing. On the right, you've got Europe, and what you clearly see is that European inflation appears to be lagging that of the US by about 6 months. I won't go into the details here, but there's a lot of dynamics in Europe about the pass-through of higher energy prices and wages in the inflation process that we would expect European inflation to lag the US. To gain confidence about the outlook for US inflation, it's important to break it down. US inflation has been hit by a number of shocks that we need to separate to enable us to identify the underlying trend. The pie chart on the left breaks down headline US inflation into its key components: food, energy, core goods, shelter, and core services excluding shelter. The first bit, the green and the yellow box, are straightforward. They accounted for much of the inflation all the way back in June of 2022 when inflation reached 9%, and you can see they've fallen dramatically so that inflation today is much lower as a result. If we look at global commodity markets and look at the price of food in global commodity markets, that's the yellow line, you can see the outlook is for that inflation to fall dramatically. Price levels have leveled off, and as the price level levels off, the rate of increase slows down. So we should expect food inflation to slow further. The second chart is natural gas prices, and you can see there that's fallen significantly. It's now down 40% versus 12 months ago, which leads us to conclude that energy inflation should be coming down. So food and energy inflation will drag inflation down. What about the second component, core goods? So these are goods excluding food and energy. The right-hand chart shows in blue the month-on-month increase in core goods from the US CPI data, and in yellow, the year-on-year rate, which is just about between 0 and 2.5%. So quite clearly you can see, when looking at the month-on-month changes, that core goods inflation is around 0. And in time, that yellow line is going to come down. The biggest part of the US inflation basket is shelter. And this is something that remains too high. The chart on the right, the blue line is year-on-year shelter inflation. There is a feature about rents. Everyone, you might have a 6-month or a 12-month rental agreement. You don't reprice the price of your rent every single month. The market rents may reprice every single month, but only for new rentals. And so this blue line is a lagged reflection of what's going on in the US rental market. The yellow and the green line are market rents. So if we have one apartment that's up for rent today and that rent increases, that will be picked up immediately in these yellow and green lines. And if the market rents remain stable, you'll find that over time the blue line will increase as people renew their contracts. So when we look at market rents, you'll see market rent inflation has fallen dramatically. And when we look at month-on-month market rent inflation, it's running in line with what it was before COVID. The key conclusion is that we would expect the US shelter component to slow dramatically. The problem is the timing of it. It's very difficult to draw a clear relationship between the market rents and the CPI basket for a shelter. But the outlook is for that to slow dramatically back to what it was before COVID. The last bit of US inflation remains stubbornly high. This is core services excluding shelter. And this chart here shows the month-on-month core service inflation rate on a 6-month moving average to give you an idea about how that momentum is unfolding. And you can see that remains too high for comfort. That's between 4 and 5%, well above the Fed's inflation target. To gain confidence on this, we need to have confidence that the labor market is slowing. Wages are the key driver of service inflation. And there is evidence that the labor market is slowing, not in terms of unemployment, but in terms of wage inflation. The left-hand chart shows the 6-month annualized rate of wage inflation. So this is the month-on-month wage inflation over the last 6 months at an annualized rate. And you can see it's fallen sharply. The right-hand chart looks at a Phillips curve, the relationship between unemployment, which is on the x-axis, and wage inflation, which is on the y-axis. And you can see that there used to be a clear relationship, and there was a breakdown around COVID. Wage inflation accelerated sharply to about 6%. And wage inflation has been falling sharply since then without any change in the unemployment rate. So there are encouraging signs that a lot of the wage inflation we've seen, part of it may be attributable to changes due to COVID and a shock rather than a change in the trend. Nonetheless, the level of wage inflation is not yet at a level that is comfortable for the Fed. For them to get their 2% inflation, wages need to be running about 3.5% to 4%. So on inflation, the data is ambiguous. We see a lot of evidence inflation is slowing, but it's not clear how quickly it's slowing. And to gain conviction, we have to have confidence that the economy growth is slowing. And this is where the second catalyst comes in. How restrictive are interest rates? Monetary policy works with a lag. Typically, central bankers take a rule of thumb. If they raise rates today, GDP growth will slow in about a year's time, and inflation will slow a year after that. So rate increases today tend to affect inflation with a 2-year lag. What we see in this chart is that the level of interest rates are in the restrictive zone. The chart on the left, it looks at the previous peak in the US interest rate cycle, and it takes nominal rates minus various measures of inflation, because clearly inflation in the late 1990s was much higher than it is today. So it shows the real interest rate. And we take it versus the change in core CPI inflation in yellow, the 3-month change in core CPI inflation, so a shorter measure of inflation pressures, and where the market thinks inflation will be in 1 year's time. So inflation is coming down. On a forward-looking basis, that purple bar is in the same zone that interest rates got to at the peak of the cycle in 95, 97, 2006. So we're in the restrictive zone. This doesn't mean that it's precisely at the top, but it's clearly at a level that you'd expect growth to slow. The right-hand chart does the same thing for Europe, where obviously there's less of a history in terms of interest rate cycles, given the euro was created in 1999. But even there you see, based on where the market thinks inflation is going to go, interest rates are at their most restrictive level since 2008. So interest rates are restrictive. And we have evidence that in the US, interest rates are starting to create risks around financial stability. And that's evidenced by the collapse of the Silicon Valley Bank. So clearly, that should slow economic growth and reinforces the message that should slow inflation. The third feature about bonds, and why they're very valuable in any portfolio, is they diversify risk. Last year was the exception, and that's shown by this chart. What you have there in yellow is the correlation between bonds and equities, a 12-month rolling correlation going back to 1986. And you'll see that line became positive over the last 12 months. As we all know, both prices fell together. What the blue line shows is core CPI inflation. And what you'll find, on average, over this very long period, is that correlations tend to be negative when that blue line is below 2.5%. So again, a lot comes back to the outlook for inflation. If inflation slows, that means the Fed and the ECB will stop raising rates. It means bonds will diversify your equities. And there is growing evidence of that interest rates are starting to bite, as was seen in the last few days with the negative correlation between bonds and equity prices in reaction to the Silicon Valley Bank story. So in conclusion, we think bonds are an attractive asset class for 2023. Valuations are now attractive. The catalysts for interest rates to stop going up, indeed start falling, appear to be on the horizon. If we wait for the data, then it will be too late. You have to invest when there is uncertainty, and our confidence is driven by the dynamics we see in US inflation, plus the evidence that interest rates are in the restrictive territory and will slow economic activity. Based on that, the next question is, which part of the bond market to invest in? The left-hand chart, this shows in green the yield you got on the 28th of February across various markets, and in contrast with what you got at the end of December. Since then, most of these interest rates are the same, apart from the US 10-year Treasury is just above 3.5%. But you'll see interest rates are more attractive globally. That's the key point. There is not one single sector that stands out. Interest rates haven't gone up because of a crisis in credit, in banks. They haven't gone up because of a crisis in US energy companies. And that's shown by the right-hand chart, where we isolate here global BBB credit spreads, the difference between a BBB credit and the government bond yield, and we take that back over the last 30 years, and you'll see that the level of spreads, or the additional yield you get for credit, isn't particularly exciting. It's below its long-term average, and below where you would expect it to be, given the expectation of a recession. So really, you should be looking to invest in a diversified global bond portfolio. And that's indeed what I do, managing an aggregate bond portfolio. And the chart here shows the evidence of what a well-managed aggregate bond portfolio can do for you in terms of other asset classes. So in the diamond in green is the fund I manage, which is the JP Morgan aggregate bond portfolio. And in blue, you've got various market indices. All these returns are showed in euro hedge terms. You can see the return of the fund has been substantially more than the index, and yet the volatility of the fund, which is shown on the x-axis with the return on the y-axis, the volatility of the fund has been in line with the index. As you would expect, if you take more risky assets, high yield, you should get a higher return, but with that comes greater volatility. So the benefit of a diversified bond portfolio is that you can be active in terms of allocating away from expensive assets towards cheap assets. You can be active in playing the economic cycle, the credit cycle, the interest rate cycle. And if you do it with good risk control, you don't add greater volatility over and above what you get for a very safe investment in government bonds or in the aggregate index. What do we like today? Well, we think the result of higher interest rates will be a recession. So we don't like high yield. We're not buying lots of credit. We like high quality assets that are cheap. And I show two here. One is the US agency mortgage-backed security market, and the other is European swap spreads. So both these charts, these all go back to 2005, so before the great financial crisis. And you can see that the level of valuations is attractive on a multi-decade basis. Contrast that with the spreads in BBB credit, which are below their long-term averages. The only time you got better levels of interest rates for US agency mortgage-backed securities was during the Great Financial Crisis. You can see the levels of European swap spreads were above the levels we saw in 2008 and above the levels in the European sovereign debt crisis. These sectors do not have much credit risk. They are not credit resilient. They are driven by technical factors, in particular, the fact that the Fed stopped buying agency mortgages. And in Europe, it was driven by the fact that banks, surprised by the interest rate hikes from the ECB, started to pay interest rate swaps to hedge their mortgage books. So being active means that you don't necessarily reach just for high yield. There's lots of things in global fixed income that can add return without significantly adding to volatility of returns. And the key thing about this is about consistency. This chart here shows the rolling 3-year return of the aggregate bond fund on the y-axis and of the benchmark on the x-axis. So every blue dot that is above the yellow line indicates outperformance. And what you see is that there is no time period really over taking a rolling 3-year return where the fund has underperformed the benchmark. And that's because of the benefits of diversification. Because we diversify our risk, we don't have to get it all right. What we have to do is make sure that we manage risk appropriately and that the trades and the strategies we put on are not the same correlated strategy. Related to that is the idea of market bias. A key factor in what we do is we do not have market bias. And that's shown here. In blue, you see the performance of the fund, and in yellow, the performance of the benchmark. So we outperform the benchmark when the markets are rising, and we outperform the benchmark when markets are falling. To put it another way, we have good upside capture, and we have good downside protection. Other funds that are diversified bond funds may give you superior returns simply by owning more high yield. And they would expect to outperform over time, but they will underperform in a recession when high yield spreads widen. And that's the key thing. You can asset allocate to a more risky asset class such as high yield. What we do is to allocate in a more constrained manner so that our returns are not dominated by the same risk factor. And that delivers consistent performance, and it delivers performance that does not have a market bias. So let me just conclude in terms of the key points before perhaps we turn to some questions. You know, we've looked here at the investment case for bonds. Last year, bonds were a terrible asset because of inflation and higher interest rates. The first that stands out is bond valuations are now attractive. They're attractive on a long-term history, not on the last 10 years. You have to look back over the last 25, the last 100 years. Bond valuations are attractive. In order to increase conviction, we need growing confidence that inflation is coming down. We're not quite there yet. But bear in mind, by the time we have that data, the market will have already responded, and bond valuations will no longer be as attractive. When we look inside the details, we see good evidence that US inflation is coming down. To gain that confidence, we need to have growing confidence that economic growth is slowing. We have that confidence because we look at the level of interest rates, and they're restrictive. They're at similar levels that they were in 2007. We also gain that confidence when we look at what's happening in the US banking crisis, and if we think forward what that means for what banks are going to do in the US. That makes us more confident. And the additional to that is that bonds then become a diversification for you to diversify from more risky assets. The place to invest today is in a diversified bond portfolio. No one sector today stands out as particularly cheap. And we have a very well-managed bond portfolio utilizing the entire platform at JP Morgan that has delivered very strong returns consistently, not just in the last 3 years, but consistently. And that's the aggregate bond fund. So let me just pause there, and Michele will come back and ask questions.
Ci portano gli sgabelli. Abbiamo molte domande, qualcuna l'avevo preparata, qualcun'altra invece l'ho ricevuta. Possiamo accomodarci. So, we can start from Silicon Valley Bank. Miles, do you think the crisis could be the beginning of a broader banking crisis?
That's a great question. I remember 2008 vividly, and it started off with BNP closing one of their money market funds, and it was considered not a big deal. It then rolled on to Bear Stearns being bailed out by JP Morgan. It was considered an isolated incident. There were problems in the subprime part of asset-backed securities. They were considered nothing to worry about. So it's a very good question, and it's an area where we have to be humble. Things are happening very quickly, and it's important to look at the incoming information with an open mind. But when we look at Silicon Valley Bank, what we find is a bank that had a very unique business model in the US. It was a bank that catered towards deposits from venture capital companies in the Bay Area in San Francisco. They had a high concentration, a very high concentration, some 90% of their deposits was very large and therefore not insured by the FDIC, the Federal Deposit Insurance Corporation that guarantees deposits in the US. And their asset side of their balance sheet was full of securities. They didn't make many loans, they invested in bonds. And obviously last year, bond prices fell sharply. Now, the fact that they're a small bank meant that they held a lot of their bonds on a hold-to-maturity basis. That means they did not have to mark-to-market them. They held them to maturity. And that's fine until depositors started taking their cash out. One reason they took their cash out is because the collapse in the NASDAQ meant that they were no longer able to access the IPO market. But as they took their cash out, Silicon Valley Bank last week then announced that they were going to move assets from their held-to-maturity portfolio to their available-to-sale, which meant that they had to market. And that meant they did not have enough capital. And they tried to raise about $2 billion of capital unsuccessfully. Obviously, in that situation, if you have deposits at a bank that are uninsured because they're very large, you take them out immediately. So they had about $70 billion that came out in 3 days. And that resulted in the closure of the bank, somewhat unusually, on a Friday rather than a weekend. So they stand out with a very separate and unique business model compared to other regional banks. And that leads us to expect that this is not the start of a broader banking crisis in the US, but we need to be humble. We also have to bear in mind the emergency measures the Fed announced on the weekend. What the Fed did is firstly, they announced that they will provide liquidity to anyone with treasury bonds or mortgage securities. But the unique thing they did is they will provide liquidity not on the market price, but on the par value. So if you bought a bond and it's fallen by 50 cents, you can still go to the Fed and get 100 cents for that bond. And that obviously means that you aren't forced to be selling assets if you have deposit outflows. The second key feature was that the Federal Reserve, the FDIC, they agreed to guarantee all deposits at Silicon Valley Bank, even the ones that were over the threshold. And this was meant to be to reassure other investors and depositors at other small banks that they will get their money back. So those two steps are important that we have to bear in mind. But overall, we don't expect this to be a domino effect through the US banking system.
But is this problem due to the Fed rate hikes or not?
I think that's an important factor. Yes, it is.
Maybe partially.
As always with these things, the institution that is taking the most risk, that is the most reckless, is the first to suffer the consequences. But the cause is higher interest rates to tackle inflation. And we need to then think about how does that affect behavior going forward? And this is, I think, the key question. Even if other banks are not as exposed, inevitably, they do not want to be on any headlines of any newspapers and suffer any deposit flight. So the natural consequence is they will reduce their risk. They will not grant new credit lines. They will not grant new loans. They will try and improve the quality of their balance sheet. And that's the key thing, which then feeds through the US economy. It's a tightening of financial conditions, not from higher interest rates, but from banks. And that reinforces our confidence that we are reaching the point, the turning point of the interest rate cycle in the US.
Now I have a question for you that maybe for me is one of the most important questions. Why did they have to choose JP Morgan for this kind of investments and not another company?
Thank you, yes. I mean, I've worked in markets for about 25 years, worked at a variety of institutions, and I think the thing that stands out about JP Morgan is the strength of the investment platform. In fixed income, we have investment centers globally, in Hong Kong, in London, in the US. Particularly in the US, we have a lot of depth. We have investment centers in New York, in Columbus, in Indianapolis. We have a great deal of resources. We have about 80 credit analysts globally. We have over 100 portfolio managers. We have dedicated teams that focus on very specific parts of the bond market. So I, as a general investor, I go to my team doing investment-grade credit or US high yield or local emerging market debt, and they're the experts. They feed me their best ideas. And this is really complemented, I think, by the experience. The leadership of our platform has between 20 to 40 years of investment experience. So when we look at valuations, we're not looking at the last 15 years since the great financial crisis. We're looking at a period spanning decades, and that gives us a bit more context in terms of identifying cheap valuations and avoiding the so-called value traps.
Thanks. Miles, what are the difference, maybe if there are advantages, between a core aggregate bond fund and a flexible income strategy?
Yes. I think the key difference is about the amount of interest rate risk you want. If you think about your options as an investor, you can buy a passive bond fund. A passive bond fund will give you market returns. It'll be highly diversified, and you'll expect to buy that very cheaply. You then perhaps move to the next staging post, which is a core bond fund. This should be giving you higher returns over time. You'll pay a little bit more for it, but the higher returns should compensate you for that. And it should be giving you a return profile with the volatility of the index. And that means that your amount of high yield is going to be relatively low, your emerging markets are going to be relatively low, but you won't simply be buying everything because it's in the index. You'll be avoiding the more expensive parts of the market, and you will actively rotate risk. A flexible bond fund is targeting absolute returns. And that means that it will be more aggressive in terms of its asset allocation. Typically, high yield allocation may go up to 70%. Its interest rate risk may go from 8 years down to 0, because clearly if the manager thinks interest rates are going up, it has to cut it aggressively. And the result is that you will probably end up with a distribution of returns that is more volatile. You would hope that over time you end up with a higher return, but with greater volatility. And typically, you'll have a fund that perhaps doesn't diversify you as much when shocks hit us, unexpected shocks, such as the Silicon Valley Bank failure we had. No one in the market saw that coming, and therefore it's an unexpected shock. The COVID crisis, the Russian invasion of Ukraine, all of these were unexpected shocks, and they hit growth expectations, they resulted in falling bond yields, And typically in those situations, core bond funds will outperform flexible bond funds because they hold more interest rate risk.
And it's core.
And it's core, yes. It's a core building block for you to think about taking satellite positions too, yes.
Thanks. And some people asked me, why should I invest in your fund, your aggregate bond fund, and not buy an Italian BTP, which has a return over 4%? And at the same time, do you own some Italian bonds or not?
Yeah, Italian bonds are part of our index. So we actively manage our Italian bond exposure. Today, we're underweight our index position in Italian bonds. I think the key reason is diversification. That's the key reason. It's a bit like saying, why don't I own a high yield security, or indeed just own the stock market? You would expect to get higher returns, but the volatility of returns will be high. And as our chart showed you on the graphic, diversification is the only free lunch in investing. What that can give you, because you have strategies that are not correlated, it can give you a return without simply giving you more risk. And that's what our chart shows, is that our aggregate bond fund has outperformed the BTP market over the last 5 years, and has done it with lower volatility than the BTP market. So diversification is the key thing.
Okay. And in the last days, we have seen a rally of the long bonds. Do you think that given this rally of the last days, is still valid to have longer duration, or maybe what is your position about duration now after these days?
It has been a very sharp rally, and the market has taken out a lot of the interest rate hikes they were expecting this year, particularly out of the US, and as expecting cuts earlier than they previously thought. Ultimately, I think, though, that it's still attractive time to be buying bonds. Why? Because the valuations are still attractive. The chart, if I look at index-linked real yields today, is now 0.9, not 1.1. So you still get a very attractive yield after inflation for buying bonds. Second, central banks' main focus is about bringing inflation down. And it's easy for central banks to bring inflation down. They create a recession. That process usually results in them cutting rates aggressively. Not cutting rates by 50 to 100 basis points, cutting rates by 400 basis points. So what the market is doing today is saying the Fed are going to stop raising rates and will adjust them slightly to around 3%. And I think the real upside for bonds is that actually, in order to control inflation, the Fed creates a recession that requires them to cut rates below 2%. And that's typically what happens in every single economic cycle. Interest rates go up, they go down, and they go back up again. And our view at JP Morgan on our fixed income platform is that a recession is likely in the US, and that gives you tremendous capital upside from owning bonds, and also it gives you tremendous diversification from risky assets such as equities.
And there is another question that I receive very often. It's about the hedging, euro-dollar. Now I think hedging is about 2%. Do you think that it will decrease in this year, or because our investors usually they want hedged bond fund?
So for our aggregate bond fund, we have options. You could buy a US dollar hedge share class or a euro hedge share class. And the difference will be about 2% because we would typically hedge using a 1-month FX forward. The hedging cost is going to be driven by short-term interest rate differentials. The US was first to raise interest rates. The ECB are following the US. And the ECB have not yet raised rates to where they want them to be. Whereas I think in the US, they are much closer to the endpoint of the interest rate cycle. The US is already seeing signs of financial instability, distress. And if that is reinforced and we get rate cuts, then hedging costs will come down, yes.
I had my last question. We are approaching the end of the first quarter. I think I have an answer because I heard you. But do you think we are on time in order to invest still, or now it's too late, maybe? I intend that maybe it's the first.
I think it is still time to invest. There is still uncertainty about inflation. And when there is uncertainty, that's usually when, as an investor, you get extra reward or risk premium for taking that uncertainty. We've got the ECB on Thursday. I expect the ECB to raise rates by 50 basis points. And I expect the ECB to be a bit less hawkish than they have been because there are uncertainties regarding financial stability, but for them to remain committed to bringing down inflation. And that's the key thing that as a bond investor you want to see. You want to see lower inflation because that gives me confidence that those long-dated bond yields are going to be anchored. So I think there's still some upside in terms of that. The Federal Reserve, they meet a week on Wednesday. My best guess is they're still going to raise rates by 25 basis points, but much depends on the performance of the stock market between now and Wednesday. If the US stock market is down 10, 15%, then I would expect the Federal Reserve to stop raising interest rates. Whereas if actually we see stability at these levels, then I think they'll have the confidence to raise rates, and again, to be a bit more data dependent. So as I see it, there's lots of evidence that interest rates are starting to create problems in the economy. And we will see over the course of the next week whether central banks are ready to acknowledge that. The longer inflation remains high and the longer interest rates remain high, the more likely it is that we get a deeper recession. And that means the more likely it is that you get substantial falls in bond yields. So I think that's the key reason to be investing in bonds today.
Thanks. And do you have an idea about when will be the first cut of the rates in US? Do you have an idea, or it's impossible now to?
It's very difficult. If you look at the macroeconomic data, you would say it would not be this year because the labor market is still very strong. We look at weekly initial claims, they're still very strong. You look at vacancies, they're still strong. Look at wage inflation, it's not fallen enough. But financial stability risk puts everything on fast forward. If you've got a banking crisis and you're introducing measures to improve liquidity in the banking system, you should not be raising rates at the same time. That's a bit like driving with your foot on the brake and your foot on the accelerator. And we know what happens then. So I think there is lots of evidence, if that is confirmed, and that will be confirmed by markets, pricing, and by consumers in the US, retail depositors, if their confidence is reassured by what the Fed have announced last weekend, then it means that rate cuts will be delayed. If it's not, then rate cuts will be happening faster. So with those things, I think you need to be acknowledge the uncertainty. And in the absence of that, you need to be investing globally and allocating capital to where there is better value in the bond market. And for us today, that means being slightly overweight interest rate risk versus our benchmark, being overweight high-quality assets that give us extra yield and are near multi-decade wides, and in contrast, running relatively lower levels of credit risk, where if there is a recession, we would expect credit spreads to widen. And importantly, that's when we want to buy.
So now, in saying thanks to you, I want to close in Italian, something it has. So, thank you very much for your contribute today. Nel salutarci desideravo chiudere dicendovi che noi già da diverso tempo stiamo tornando a un approccio più tradizionale che crediamo sia assolutamente indispensabile dopo, diciamo, gli ultimi 3 anni in cui ci siamo un po' riempiti di tematici, di flessibili, di varia natura. Approccio tradizionale vuol dire quello che abbiamo appena detto, quindi bond di alta qualità. Avete visto in questi giorni come hanno ballato tanti flessibili a differenza degli aggregate che sono rimasti molto stabili, anzi sono saliti. Così come nella parte azionaria riteniamo che sia importante tornare al global equity, che non sia né growth né value, perché anche lì ci giochiamo decine di punti di differenza negli anni e quindi è indispensabile viceversa essere più neutrali rispetto al mercato. Ci trovate al nostro desk, grazie a tutti di essere intervenuti e buona serata.